Good morning, everybody. Welcome to Tuesday. More fun and games this morning from the Bank of England, which we'll touch on in a moment. Good morning, Stel.
Hello, everybody. How are
you,
you,
mate? All right.
Welcome back.
Yeah, thanks, mate. How you doing?
I'm very good, very good. Just a heads up, I'm expecting a delivery, so at some point I'm going to be off for like 2 or 3 minutes.
Okay, no worries.
It's a new Ferrari. No, I'm kidding.
Toy car one.
Yeah, exactly. How are you, mate? Everything all right?
Yeah, all good, mate. All good. Getting stuck back into it after a few days off. Always nice to have a relaxing month.
The bell's just ringing, so I'll be off for 2 or 3 minutes. I'll be right back.
Okay? Yeah, no worries, mate. Cool. Well, good morning again to all you guys and girls. Let's get into it while Stelios takes delivery of whatever is getting delivered, probably new beachwear, no doubt. Right, we'll start off with China. We've obviously got this ongoing stuff with the National Congress coming up on Saturday, but there's, as I mentioned yesterday, there's going to be a few headlines popping around in and out the press. One of the headlines from the notably state media saying that China must stick to its zero COVID policy, and that zero COVID is sustainable and it's key to stabilizing the economy. So that's potentially a message put out in the press that at this Congress they're going to maintain the zero COVID policy. It has been noted in the press that a lot of the leaders and the important people are appearing in meetings without masks, which might indicate there may still be yet a shift, but the lines being given out to the press overnight is that they must stick to their zero policy. We had the RBN.
Hello,
mate. That was quick.
Yep.
Cool. We had the RBNZ out releasing their annual report. Really, there's only one comment that the press have picked up from Governor Orr, saying that there's more work to do on inflation, which some in the market have taken as an insinuation that maybe they're not quite done on hikes. As we heard about a couple of meetings ago, they thought they might have 2 more hikes in them. We've had one of them, so 1 more to go potentially. But that comment, as I say, has been picked up and used as if they might continue hiking. Of course, we think that they're probably maybe only going to go on pause and wait and see what happens next, rather than saying that's the end of the hike cycle forever and ever, come back later. So we'll see what happens there. A load of Japanese bods have been out overnight, the old usual finance ministers, government people talking about FX, same old lines. But Suzuki came out with a comment, Finance Minister Suzuki, saying he will explain the stance on intervention at the G20 meeting. So again, reiterating that is going to be a big subject that's going to be talked about this G20 next week. The famous currency diplomat Kanda said he can make a decision on intervention from anywhere, even from an airplane. So fending off questions there about how and when they can intervene. I'd like to see him do that 20 years ago, maybe even 30. How long ago was it when you used to smoke on airplanes? Still, do you remember that?
That was over 20 years ago, right? Oh no, more than that. I still remember that because you're like row 12, which is non-smoking, and row 13 is smoking. It's like, what the hell? Everything goes everywhere.
So yeah, so now you can use phones on planes and mobiles and get internet on planes now. But yeah, I remember the days when you could smoke on planes and smoke on the underground. They were always fun days going to work if you had to get on the smoking carriage. But anyway, that's modern technology for you. He can work intervention from anywhere. Now, Fed's Brainard was out yesterday as well, and some of the press have been making a bit of a thing about it. We had our old mate Timmy Leaks this morning in the WSJ saying that a couple of Fed members are potentially warning on not hiking further past where they're set to go now. But Fed's Brainard was basically saying that it's still going to take time for the tighter policy to affect the economy. So again, what we were talking about yesterday, that my opinion particularly is that you know, we've hiked a long way, hiked really fast, not really seen any major effects, and that's what Brainard was highlighting there.
One thing, Ryan, one thing to add is that she did say that we're going to be monitoring the how did she say it? Market conditions or something like that, and that's I think what the market picked up on as being, you know, if we do see a big old move now, lower in you know, risk and all that, that this is something they're going to act against. That's what I think. That's
the financial stability aspect.
Yes,
the thing from the banking as well. But on the other side, she said that easing prematurely is a risk, but at some point the risks could become more two-sided. So again, touching on, you know, the potential for a pivot that is not going to be as quick maybe to pivot. I don't think the Fed are going to pivot. I don't think you're going to get to the end of hikes and then the next thing is going to be a cut within a few months. The Fed are going to sit fairly high. In my opinion, they're going to get rates where they want to go. They're going to see the effect on inflation. They're going to keep them there. And in my mind, it's going to be some months before they start cutting.
It will depend on how the market forces them to or not. I think that's, but I agree with you. You know, there's no point for them to stop and then just go reverse straight ahead, but it's going to depend on the markets. Yeah,
well, as we know, the market's been trying to trade the pivot for the last 5-6 months. So as soon as the Fed do announce at their terminal velocity or whatever they call it, you can bet you the markets are going to be pricing in those rate cuts, and that's where we're going to get the swing the other way in the trends. That's what we need to watch for. But within that, we'll still get a trade, because if the market overprices the Fed cutting, and the Fed comes out at their next meeting and say, no, we're not cutting anywhere close to cutting, well, you're going to get the market going the other way again, and lovely volatility for us to trade, hopefully. Now, Goldie's was out as well, saying it's too early to price a Fed pivot. So they're on the back of that. Probably means we're going to get a pivot next week if they're usual things, anything to go by. So they were out with a note on that, saying too early to price a Fed pivot. Now over to the UK, there was a survey out, an employment trend survey out overnight, highlighting that labour shortages are hitting output, and 46% of firms are saying that it's hitting output. Now this is coming alongside some UK data that we had out this morning, jobs data. Where's it gone? Am I on the right page? Where are we? So yeah, there we go. So the jobs data was a little bit on the soft side. The claimant count for September came up 25k. So that's people claiming unemployment, if you like. That's been largely moving in the right direction, or really small numbers, but a bit of a jump there, much higher than expected. But the employment change, the three-month change, down 109k. Again, this has been a number that had been really strong for the last few months. So a bit of a negative number there coming in. Could be a sign that we are potentially seeing some weakness in the jobs market. But again, pointing back to that survey where they say there's still a massive skill shortage and it's affecting output. So the construction industry was cited as one of those cases there. So bit of a difference between what's been surveyed and what we're seeing in the data, but we'll keep a look at the trend going on there. If we start to see this number here continually coming in negative, we start to see the claimant counts continually positive, it's gonna start to affect the market. But all that comes, and the unemployment rate dropped a pip. So again, a bit of a mixed bag from that data. On the wages front, because obviously this is inflationary, wages up to 6%, beating expectations. That's if you strip out the bonuses. Sorry, that's with the bonuses. If you take out the bonuses, it's up again, beating expectations, slightly lower level than the 6% in the headline number. Still running below inflation, which is still causing a lot of angst here with strikes in trains and other utilities. That's ongoing here. And in a lot of countries, in France, there's issues with petrol because refiners have gone on strike. So these strikes are happening across the globe.
What, the French are on strike?
Due to all this inflation.
Unbelievable.
Now, the Bank of England has mentioned they've come out this morning with yet another round of bond buying. They've expanded what they're going to do, and they're now going to purchase linker bonds. For those who don't know what they are, they're similar to US tips. They're basically index-linked bonds, primarily tied to the inflation rate. So they guarantee the rate whatever inflation is. So, for example, if you buy a normal bond at 2%, inflation is at 10%, you're down in your effective real yield. But if you buy a linker, it's indexed to inflation, so you will get your 2%. Whether inflation is 10%, 8%, whatever it is, you will still get your 10% on top. It will take off the inflation there. But they're stepping into that part of the market now as well. Slightly different. They're putting in a more of a yield curve control on that. So they've set a limit of where they will, or of the yield, where the yield can get to before they will enter the market. Their first round today, they bought just under $1 billion in that market. The other gilts they're buying, that doesn't happen until 2:30 this afternoon, so we'll get to see what the numbers come out from there. But yet again, it's all linked to this pension stuff, but it is another potential leak that's sprung in the pipe that they're sticking another finger into. And again, this is going to be something that's going to be potentially brought up at these G20 meetings. No doubt Bailey's going to get a lot of questions on that. He's due to speak today alongside another BOE bod speaking, Cunliffe. So keep an eye on those comments there. Some extra explanation on those. In the UK, Santander, the bank said that they've seen an increase in mortgage holders falling behind on payments. So they're putting aside extra money for defaults. So getting ready with the gunpowder, if you like, to make sure they're fully liquid against any defaults. But it's not good news that we're starting to hear people defaulting, or not defaulting, but getting behind on their payments. Obviously, interest rates looking to head higher still. It's going to put even more pressure on people on standard variable rates, people trying to get new mortgages. We heard over last week and the week before, UK banks particularly pausing or stopping new mortgages while they then reconfigure them to take into account the higher rates. So could be that we see a lot of people scrambling around to get a good deal and lock themselves into deals before the rates have gone. If they haven't done that 6 months ago, then they're going to get caught out because rates are going to be heading high and the banks are going to be making sure they get their prices up. On the flip side to that, though, and what we don't hear a lot of, is that savers are obviously getting boosted. Savers have had to deal with low rates for years now. It's really been a bane of a lot of people who, they don't have debt and they save money and they're not getting any returns on it. But I know here in the UK, every 5 minutes I'm seeing a new deal come out for saving rates, and they're getting up towards the 4.5%, 5% mark now, whereas a few weeks ago they were running at 3.5%. So there's always two sides to the story. So one, we hear mortgages going up, obviously saving rates are going up as well, which can offset the negativity you get from mortgages, because people who do have money and are saving it, well, they've got that extra income and they can go and spend it. Sorry, Stel, was that something you want to add there?
No, I was actually going to ask, are you seeing, but you did answer the question before I asked it. So you are seeing banks increasing the savings rate, the interest rate on cash, basically, on savings, are they?
Yeah, there's all I read about every, you see an advert going through the internet, and they're all offering, 1 year fixed, 2 year fixed savings.
Oh wow!
Vehicles.
Yeah. So they need cash basically, because here in Greece there's a big lag between rate hikes and you getting anything more on your cash. But yeah. I'm not sure it's a good thing to have the banks offering all these. Oh, give us your cash and we'll give you 3, 4, 5%. Anyway.
Yeah, no, but then it potentially works the other way. If housing market's going to slow down, mortgage market's going to slow down because people don't want to, get a mortgage because of higher rates. They've got to get their money, like you say, they've got to get their money in elsewhere. So offering savers, fixed rate. A lot of these are fixed rates, so you have to leave your money in there for a year or 2 years. And obviously, if they can borrow your money for 3.5%, 4%, and rates are going to go to 5%, they can lend it out much higher. So that, it's the margin game, as you know. But they can't. I'm surprised they've gone above what the actual rate is. As I say, I've been seeing them up to 4.2, 4.3, 4.4%.
Yeah. It's the old 3-6-3 rule, remember? Borrow at 3, lend at 6, and be on the golf course at 3.
Yeah. God, wish that would still work trading. Yeah, we wouldn't be sitting in there, mate. We'd be on the course ourselves. So yeah, anyway, that's what's happening in terms of that. Story I read in Reuters that hedge funds are back into oil. This is coming as let's get the oil pricing up. This obviously comes as we've had OPEC Plus saying they're going to cut production. Apparently that's triggered hedge funds to get in about 62 million, I think, in worth of futures up to October the 4th. So they've stepped back into the market, obviously with the backstop, they hope, of OPEC Plus. So that's been one of the reasons behind at least the latest rally in oil. Sorry, mate. Did you?
Sorry, was that I was unmuted. Sorry about that.
That's all right. If you wanted to add something, but yeah, a few people, querying the strength of the oil market. Obviously, the OPEC cuts is going to do it, but now we're getting these guys coming in and thinking there might be a bit of a free lunch on offer. The fact that was up to October the 4th means that now we're hearing about it. Anyone who wants to front run it is likely to get spanked, and as we can see from oil there, well off the highs since those guys got in. But just a bit of background there to what's happening in oil markets. Now, again, going on to these G meetings, Germany's Scholz wants an international agreement on energy prices. He's going to discuss this at the G7. He will also discuss the US CPI Act, or the US Inflation Act, that the US is coming in, because he doesn't want a customs war. That's one of the parts of this US Inflation Act, to lower inflation, to look maybe at customs charges, lower those, take them off, whatever. It just reduces costs a bit more. But as Scholz says, then you start creating a bit of competition, because if there's no customs to the US, or lower customs to the US and elsewhere, that gets competition of where people buy from and sell to. So that's something he wants to bring up amongst his buddies. He also wants to discuss the ratification process for EU free trade agreements. He wants those reconsidered. Obviously not happening fast enough for him. It's also a bit of a poke in the eye to the UK, who have been constantly be told that ratification takes as long as it takes, and there's no way of rushing it. Obviously now Germany's in a bit of a pickle with energy markets. They want to start, or he wants a faster ratification process, because he's going out and looking at energy deals around the globe, and wants those done quicker. So, you can't have it both ways, as someone said to Theresa May once. You can't have the cherry on the cake as well. I think that was Juncker, somewhere along those lines. Anyway, that's what I've got on the headlines so far. Stel, you got anything you've heard or want to add to that?
Not really. You always do a splendid job of covering events and stuff. I mean, the thing I'm still I think is the most market moving thing is still Ukraine, and we're seeing escalation, and we're discussing this when you were away, I think, was it? Anyway, we're discussing about how Putin is escalating to de-escalate, probably, or possibly, or hopefully, maybe. But that's one place where when we do get the good news, which are going to come at some point, then this will change the dynamics of everything, because that will not immediately, but that will start bringing down inflation, right? Because that means that natural gas, oil, everything gets the squeeze is off, at least temporarily, and it takes some time to feed through to the economy. But you know how markets are; they react first, and I'm convinced that if and when we see this, positive headlines coming through, I think markets are going to get really ahead of themselves and try to understand exactly when the central banks are going to say, right, this big obstacle is finally away from the main picture, the big picture, so we can possibly take our foot off a little bit, the accelerator. You know what they're going to say. So so I think that's one big event risk that's still out there, and I think it's bigger than anything else for me at the moment. It tends to get forgotten, every now and then, but that really is something that's going to drive everything, I think, in the when that occurs. But no, in terms of headlines, you've covered everything. I don't have anything else to add. Yeah.
Thanks, mate.
Splendid job. Well done.
Thank you very much. Thank you very much. Alan's just put up there that he hasn't seen his rates going up on savings on existing accounts. Yeah, very much so. That's one area where saving rates haven't gone up in line. But as we said, this is a new customer grab or new deal grab. So all these rates I've been talking about, these high saving rates, are new products. As I say, a lot of fixed term products, 1 year, 2 year. You can put your money in. Some have big levels, putting up to $1 million. Some have smaller levels. You will get 4.5%, but only up to a maximum of 20 grand or something. So these are all new products coming out. But if you're just a bog standard bank account, no, we haven't seen the rates going up there, and they will be very slow to put those up again. Purely a margin play. Thanks for that article, Gavin. I'll have a look at that, because there has been also, just quickly, there's been a report out from, I think, the Institute of Fiscal Studies in the UK on the expected news from Kwarteng and his pricing. And they say that he's going to have to find at least 60 billion of cuts a year to pay for whatever the stuff he wants to do. The only thing I'd say about that report is that these guys used Citi for their forecasting. And we know what Citi are like at forecasting. So I wouldn't. I'll take all those numbers with a big bag of salt. But that's the sort of thing that's doing around the market on now. And thanks, Gavin. I'll have a look at that piece in a mo.
Ryan, so, one thing I wanted to add regarding Kwarteng and the plans and everything, it's going to be very difficult to really go through with cuts in an environment where inflation is ramping. Disposable income of the average person is getting reduced massively, and then the government coming in and saying, "Oh, we're going to cut this and that and the other." I think it's going to be very difficult for them to actually fund that with anything else other than new debt. I really do.
Yeah, and so, that's the crux of it. That really is the crux of it. You can't have tax cuts, or tax cuts can be good and can be stimulative, and that. As Kay's mentioned, that could be good for the UK down the road. But the market isn't down the road. It's looking at what's happening now. And it's seeing the UK having to borrow more money in a higher rate environment to pay for tax cuts. It doesn't like those sums. And quite rightly, it doesn't like those sums. But we'll see if maybe he can pull a rabbit out the hat. I very much doubt it, but he'll give it a go. I know that. So, as I said, when this stuff comes, the market will listen to what he says. Then the market will listen to what the OBR says. And if it's positive or negative, then the pound's going to react on that. And then from that, we have the Bank of England a few days after. But then, anyway, that's Halloween at the end of the month. So we've got a bit of way to go until then. Right. So just going to have a look around a few pairs. Now, I'm in a bit of a quandary trading wise myself. I like my preference is to trade long term, a bit like Stell. I don't really like getting into the scalping stuff, but needs must, and you get on with it. But long term, I like trying to get the long term trends and being in early. And I feel like we're getting towards a point where the dollar strength is going to be a stretch point. I think there is risk this week of communications from the G20 to that effect, but I'm not wholly going to trade on that. That's just a bit of a punt, whether they do or whether they don't. It's a 50-50 call. But I am getting a bit twitchy about getting short dollars. I've already started against the yen and against the Aussie. Very small trades, because I think with all this volatility, and as we've seen, the market is moving very far. So I'm taking that into account. I'm not risking a huge amount, not even risking 1% on some of these trades, a bit like with the cable the other week before I had the blowout. But I am looking to get short dollars and hold for a bit, because I can't see how much more hawkish the Fed get unless inflation really takes off much higher than where it is now. I'm talking getting up to the 10%. That goes the same for yields. The market knows where the Fed's at. So I'm just finding that I think there's barriers to how high the dollar can go based on the fundamentals. But my problem I have is that the market can go much further than what I perceive, or if you like, can afford or want to afford in a trade because of the volatility. But if you take something like dollar yen, I'm a bit more conviction playing this at the moment, because the volatility has been sucked out. We knew it was running high. We had all that volatility. We got the intervention. The market got its smack round the chops. So the volatility is out of this, but it doesn't mean it's not going to go higher. We've had this move above 145. This was the level where everyone thought maybe they'll draw the line, the MOFBOJ. That wasn't the case. We've been above it. We are above it now. I'm hearing a lot of people chattering in the market at 146 because that's where they supposedly intervened. That's the level they're going to be defending. Again, I don't think that's going to be the case. That's not their objective, individual numbers. Now, not going to rule out the fact that there may be some entities in there smoothing this current ascension, if you like, just layering in some offers, maybe from some of the big pension companies as K-rumored yesterday, potentially happening. But if you look at what it's done over the last few days compared to what it's done the weeks before, and compared to what every other dollar pair has been doing, the volatility is well sucked up. So I'm looking to build a longer term short in this. I'm happy to run it up to about 150. That would be my assessment point, see what happens up there. If that breaks, then obviously something's going on. I will be taking into account the volatility in this. If I start to see it moving 100 pips at a time, I'm either likely going to pull the trade or just sit back and let it do its thing before adding to a position. But I am keeping it very small. So on this basis, 146 is a big number here. I think it might have the same reaction to what we had at 145, where we had a break and it got a quite decent push through. Because if there are people potentially trying to front run intervention or thinking there's going to get intervention here, if they're proved wrong, we get to 146, 10, 15. There's likely to be a ton of stops there. We'll probably get an acceleration through there, maybe similar levels, 30s, 40s, 50s, before the market calms down again. So I was looking at a trade this morning into 146 to put in the long-term pot and just have a short-term scalp. We didn't get up to sort of 95s. So I'm not going to try that again potentially if we get up to here again today so quickly. But this is a big level at the moment for a few people in the market. Obviously, if we break above there, let's get into, let's go right the way back. I just need to go on a weekly. So if we do get above there, you can see some of the levels that we're talking about coming into play. Big fibs coming in round about the 147. Sorry if it's not too clear. Oh, have I got another chart? Let's see. Let me take that out for a second. There we go. So 147.36 is a big fib level. It's also up near the prior highs that we got back in 98. So that's going to be a huge level up there, at least technically. if we get a push above this 146 area. So these are the sort of levels I'll be looking at to short against to add to this position. The trend isn't over. There's no signs really to say the trend isn't over. If we come back down to a shorter term, as you can see, you know, apart from the intervention move, we've been held up pretty solidly, really. So the market isn't yet ready to turn tail. You want to talk Fed pivots, anything like that, Bank of Japan pivots, whatever you like. There's nothing that indicates the trend has changed as of yet. So there's still a long way to go for this one. But one I'm keeping an eye on, as mentioned. Now another trade I was in got blown out this morning on the trailing stop. Don't know if you remember, I think it was just the week before last, we had that comment out from the officials in China about the level of the yuan. We got a comment out that they were potentially going to intervene. That was when we were at 718, and a few of us jumped on that trade. I managed to run that all the way down. My lowest exit was 706.11. So down here just before I went away last week. I didn't get in on this move here, unfortunately, but I had my trading stop just above this level at 7.1750, and that got knocked out this morning. So this zone that we've got here, it goes back to the double top, going back 2019-20. Let's have a look. Back to there. So that's the zone there that I tried to short against when we first got up into it, and that got knocked out in this move up through the 720s. We're back in this zone again, and it is playing up a bit more technically, as opposed to when we got that volatile move break through it. So this zone, give or take, is holding. So again, it's an important level to watch. We have had some light, well, almost opinion pieces that the reserve requirement ratio cut could be coming from the PBOC. We have got this week, I think maybe the 13th, their rate decision on one of their lending facilities, the MLF, the medium-term lending facility. They could cut rates there, but there's been a bit of opinion piece out that they could use the RRR instead of the MLF to get their message through. So as far as the PBOC are potentially concerned, they're still on an easing bias, which will mean that the yuan weakness can continue here. But as I say, technically, if we get through this zone, you know, get above that 1920 area, then we're potentially heading back towards the highs, and we'll see how that reacts. If we get a nice hold again of that previous high in the 26s, that'll potentially be a good signal for a decent double top, and we could get a decent pullback again. As always, we listen to what the officials say. If they come out and start saying that they've had enough of one weakness, it's not going to be a one-way trade, that's your marker that you've got a temporary top in place. So that's what I'll be looking at on that side. Still, anything you want to talk about while we're here?
About markets?
Any pairs of assets before I move on to something else? I was going to have a look at gold.
A couple of people are actually mentioning that Goldman Sachs are bearish on cable. And, you know, I don't disagree. I've said for a while now that I think there's very little reason to be bullish on pound. Not yet. The time will come. And also I want to repeat what I've been saying pretty much every day, I think. My macro bias has not changed. And I think risk rallies should be sold. And I think we're going lower until the Fed tells us. I've placed a marker. I think 3,300 in the S&P is probably the level where they start getting like squeaky bum time. But and we're getting there, right? We're getting close now. And I've been saying that from what 4,400 or something like that. And it's been going steadily. And we're still in tightening mode pretty much everywhere. And as long as that happens, there's really no reason to be going against this. I can't stress this enough. I said this yesterday, I said this on Friday, and look what's happening. We're grinding lower every time, and all these people who are trying to get long, yes, okay, if you're day trading, you might catch a nice little bounce somewhere, but if you're not, it's disaster every time, right? So I just want to say it one more time. Don't try to be a hero and call the bottom. And oh yeah, this is the bottom. You know why? Let the market tell you, or let the Fed tell you where it is. And when if you miss the first little move, the first 2, 3, 5%, it doesn't matter. You can catch the rest of the trend. But I don't have anything else specific to say because nothing has changed in my view. And I just want to repeat it often so that people hear it. And obviously, I'm not telling people what to do. I'm just saying what I think the markets should be doing. And so far they've been doing pretty much that. So risk has been sold. Any rally has been sold. Same with bonds. Same with everything. And let's also note, cryptos are close to their breakdown point. Like Bitcoin is $1,000 away, and you can be sure that when that breaks, that's going to create ripples elsewhere because cryptos are big now. They're not the 50, 100 million market cap they used to be. They're a lot bigger. So they're going to make a difference.
Yeah, definitely. I just want to answer Mike's question there because he said, "Hey, but a lot of people get burned calling the dollar top." You're absolutely right. But there's ways and means of doing it, which is why I tend to trade more longer term because it takes me out the noise. And when I trade long term, I'm looking for the signals that potentially say that something's going to change in the market. I mean, those have been in with me at Forex Flow in our chat room and also here in ForexAnalytix. I traded dollar yen when it was down in the 100s, pretty much on the back of inflation was going to start coming, if not for the one reason that no one was expecting it. Everyone was telling us it's not coming, and yet the data I was watching suggested it was coming. That's where I started scaling in for longs in dollar yen down in the 100s and rode it all up to the 120s. I'm looking to do similar here, but I'm taking into account the fact that we're potentially not done with inflation, not done with the Fed, not done with highs in the dollar. But I feel we're getting to a level where potentially we are nearing the top of where the Fed might go with rate hikes, 4.5%, 5%. So I'm happy to start building positions in certain pairs, but I'm keeping it much smaller than I would normally because of the volatility, because the dollar can still go a bit further. If we get some bad news, or if we get some news out of this G20 that everyone's happy with the level of the dollar's going to take off like you've never seen, and I'll be the first one to be hitting the exit button on my trades. But that's why I've got conviction, but it's not huge conviction. Markets, the fundamentals, the Fed have got to do a lot more to get the dollar higher just on those basics. So just on the fundamentals, a lot has got to be done to push the dollar higher. Now, market expectations are a different thing. If the market thinks Fed's going to 6-7%, it's going to trade that way, and yields are going to go up, and the dollar's going to go up, and I can't do anything about that. And so my attempts to pick the top in the dollar will likely end in tears, but I'm in control of the trade. If I don't like the look of it, I'll get out of it. Even if I get in all my entries up to the levels I want to potentially trade at now, I'm still risking potentially less than 1% of my account on this trade. So that's a worst case scenario. So yeah, I'm not trying to pick a top in anything. I'm just using my experience of looking at the fundamentals and thinking, right, we've got to this point. What does it need to do to get above that? And I think there's a lot of work it needs to do. So I'm happy to try and see if the trade can work that way. And we'll take it from there. But, I'm not here to crow about I've picked top in this, bottom in that. That's why I spread my trades out. The top may not be here. The top may be here in dollar yen at 146. Who knows? Not going to know until the price action tells us that. And if it breaks to 147 might be the top. Who knows? I'm not here to park my bus at one price and say that's the top in the dollar, and then I'm offside because it's trading 150. That's not how I trade. I've got my ideas, and when I've got enough conviction to trade, I trade, and what will be will be. Right, so look at some of the other. So Ryan, you will not be waiting for the Fed to pause. No, I'm not waiting for them to pause. If they do pause, that'll be a bonus. That will help the trade, obviously. But I'm naturally thinking they're going to pause around 4.5%, 5%. That's my view, unless the data tells us otherwise. We get inflation this week, 9%, core up at 8% or whatever, shooting higher. Then things have changed, and I'll assess my trade and make the decision based on that. All I can do is manage my risk. I've got no control over anything else. No control over inflation, what the Fed does, Fed speakers, anything. No control over that. All I've got control over is how much money I'm prepared to lose on a trade. And my maximum, very maximum, will be 1%. Likely much less if it all goes wrong. That's the only thing I have control over. That's the only thing we all have control over. Right, let's get back into markets. We probably should do a whole big show on that one day. We'll just talk about how you manage your risk, how you set trades out, why people trade differently. I know Stel's a longer term trader. Why do you do that, Stel? Is that because you find it more comfortable to trade longer term? You're not caught up in the 5-minute noise, what happens every day.
Yeah, it's interesting. Your question is very interesting because I used to be a market maker and I was anything but long-term trading. I was doing like 100 trades a day and big ones at that. So
yeah.
but that was in a different environment. I was working for a bank. I had all the infrastructure, all the information coming through and flowing through, and it was a very different thing. And also I had to make 1,000 prices a day because I was a market maker. So you have to do that. But anyway, when I returned, when I left the bank and I came home and I said, I'm going to keep trading, I tried to do the same and got burned because it was just me on my own, right? So it's a very different proposition. So I then, given circumstances, I then, tried different things, experimented, and I found that as I get older as well, I can't be waking up at 3 a.m. looking at my feeds, so it's a 30-year position for me as a scalp. Thank you, Alan. So, I found myself wanting less stress and, and it kind of matches me a lot better because I like trading with a macro view always, and you guys know me. I put on a trade, I'm not going for 0.5%, and also my stops are a lot more generous. So it's what suits you, and in the end this is what I found that suits me, and that's it. Everything is different for everybody.
Yeah, and I think that's something a lot of people struggle with, particularly part-time traders. They may get a couple of hours here or half a day there, and they think they've got to try and cram in a month's worth of trading in that one period of time. And I think that's wrong. I think if you're a part-time trader, you need to look longer term. You need to look for the bigger swings. You need to have more patience and try and pick that chart there in gold. Look at the big double top up there. You've got to try and trade those sort of things, the real big areas like this 1675, 85 area. You have to wait a long time for it to come, but you're not caught up in the noise. I mean, if you trade, twice a week and you're watching gold and you miss this move up to the high, you didn't get in there. Well, you've got to wait a few months and pick your levels. Where's your next level? Well, now we got another set of highs here. Those are the levels you need to look for, and there's months in between those. But if you wait for those and they work, the rewards are much bigger than trying to scalp, 20, 30 trades in half a day, something like that. And it takes a lot of the noise out. It takes a lot of the pressure off because you're not trying to grab every single move because you feel, oh, I've got half a day to trade. I need to make money in that half a day.
Exactly.
It's all about just making the money when you can, but doing so in a way that complements the time you can give it. I'm different. I can sit here all day long and I might jump in and out of a trade here, there and everywhere. And that's because I'm sitting in front of my screen all day. But if I wasn't, then I'll be purely looking at the, more swing trading, looking for the longer term levels, the wider levels that don't come around every 5 minutes. I think that is something that a lot of traders need to bear in mind, depending on how they trade.
Wise words, mate.
Thank you, mate, and the same for you. So right, let's look at gold then. You know, we had this big zone going on here. Again, something we've been highlighting for quite a while. Big zone. These are the sort of technical levels you like, whether it's short-term or long-term trader. And today we're messing around with this zone a bit as well. You know, we had the break up through it. So the breakdown, then we're coming up, finding resistance, couldn't break. Then we get a steep move down. Again, finding resistance on the way up. Then we get the break. Just after the break, as you can see there, we find a bit of support coming into it. Come back down, bit of support. Then we get a break all the way through. And now, just here, we're starting to see a bit of resistance coming in again. So this gold level, I think it's still following yields. I think it's still following the dollar. It's not leading anything risk on, risk off, or anything like that. It's purely following what's going on elsewhere, which sort of can negate the technicals a little bit, because if something else is a big driver, the technicals aren't really going to matter. If those things are moving, it's going to drag this which way it needs to go. But when you get these moves and things quieten down, then you look at the levels to come in. So we've got, you know, pretty much a little bit of consolidation. Perhaps we're going to see between this 1675 and this 1659.60 area, which is where we found problems again. Going back over the last few weeks, it's where the price has done something every time we've been here. So we could ping pong a bit here. If we do get a break through this 60 level, probably going to need to clear 54, 55. If we do that, then we get a move down, perhaps to this 1640s again. So if you are looking to short gold, I wouldn't necessarily short it down here against this line. And if you're going to short a break here, you know, be careful if it doesn't clear that 54, 55. It could prove to be a little bit of a false breakout. But if it does, then we're potentially heading back to the 50s and maybe more so the 40s down there. On the flip side, it's going to need to get back above this area again. And if it gets into here, finds resistance at the top, doesn't look like it's going to break, then if you're looking for shorts, that's where you want to play it. Those who want to get on the long side, again, you can lean on these levels. As I said, if you're going long against this 60 area, you want to potentially have your stop below that 54, 55 in case it gets down there, holds, and then bounces again. Alternative, wait to see if we get a break up here, but I'll look perhaps for a confirmation. So maybe a break move, a little bit of come down, test the level, confirm that there's some support there, and then perhaps we get a move back up to the 1700s and a bit more. For me, I'm not keen so much on trading it around here. I may look towards the lows if we get down towards those 1620s, maybe the 1640s, for potential for trying to look at longs. But I'm going to be watching what happens elsewhere because there are bigger drivers coming in around that. Right, guys and girls, if you've got any other pairs or anything you want to look at, please throw them up while I move on to one of the other pairs. Going to look at dollar CAD, which is looking very interesting. Again, looking more from a longer or wider perspective on this one, because we've got some big levels in play coming up if we manage to get another break. So this 138, I'm going to call it 30-50 zone, because it's been a bit in and out of that area. This could be a bit of a trapdoor or loft hatch, if you like, open for a move up to the 140s at the very least. But we have got some big levels coming up in the 140s, 142 and a half, 60s, and then this big double top one up near 147. Again, from a longer term perspective, if you've got patience, these are the sort of big levels you want to give a go. Because if they do show up, they're going to give you some decent returns. You know, a test and hold of a first try up here in the 147s. You know, I would expect to at least get it back down to 146, 145, something like that, if the level is really solid. It's not saying you bet the farm on it, but I like the big long-term levels like that where we haven't traded them for a long while. We get a move up there, and I like the conditions for why we've gone up there. Then I'm potentially going to have a short play against it, see what happens. And if it runs for 50 pips before turning, so be it. I'll be cutting the trade, slicing the trade locking in my stops behind it, see what happens. But this 138, 50, 40, 50 area may be worth looking at for a potential break trade. Again, dollar CAD is something that is being pulled and pushed by what's going on in other markets. So again, I'm not looking at this one because of what's happening in the fundamentals there. I'm looking at what the big drivers is. Obviously, oil is one of the big drivers there. But even while we've seen oil bouncing a little bit, you know, that hasn't really played into this one. You know, we got the big bounce in oil, as we said, hedge funds piling in, so on and so forth. But still, this pair's gone up, so we haven't seen CAD gain on oil. So again, just shows you what's really driving it. It's mainly the dollar, but potential for a break trade there if we do get through that 38.50s, call it that. Mike wants to look at cable quickly, and then Mavi wants to look at pound Aussie. Okay, let's look at cable. Right, so still looking fairly ugly, obviously. Let's go into a bit of a shorter term chart. I keep drawing this fib lower and lower and lower. So some of these fibs are not really in play because I keep getting redrawn every 5 minutes. So I'm not really looking at those. But as you can see, just taking the big high low there, you know, 118 is where we're looking at to change this trend around, and we're miles away from that. So still a lot of work to do to change this around. But just looking at the shorter term charts, really a bit of middle ground here. You know, we got that move back up to 115 off the panic collapse and the Bank of England action and all that stuff. So we're pretty much, you know, bang in the middle here. 110 has obviously shown up again. We got a pit below it, I think, overnight or early this morning. So that's pretty much our marker at the moment, this 110 area. If we break that, then we're heading down 109s, 108s. This level, I think this 105.50 is the old big level from the weekly. This is the big massive low. Where are we? Going all the way back to that the 1985 level that everyone was speaking about before. Obviously, it got flushed during the Asian time zone when we had that breakdown. But what was interesting is after we had that, this is where it found support again sometime later. So that to me is again going to be a key level if we get down there. If we manage to hold that level, that's going to be sure signs of stronger signs of a potential bottom in where people want to take the quid. And then from there, you're going to be running 105s to 115s. Nice 1,000 pips to play in, but this is cable. We can do that in a couple of days. But what are you looking at yourself, Mike? Let me know what you're looking at there. Oh, excuse me, I'll grab a glass of water. Right, pound Aussie, not one I look at a lot. I don't even think I've got it in me list. Let's have a look. Might have it down here somewhere. There we go. So don't expect a huge amount of tech in this one. But I know a couple of you guys were looking at that a few weeks ago. So I haven't even redrawn the fib on that one. So let's get rid of that for now. Oh, come on. Now, what it has done, obviously, is bounce strongly from, obviously, that smash down that it had, as everything else got. Again, back up towards levels. I think we were talking about these 170s. I can't remember who it was talking about it a few weeks ago, but we've got a big, strong area up near the 178, 79s. That's going to be the area to look for if we find resistance. That could be like the 115 for cable at the moment. Obviously, a bit more longer term. Downside, probably looking around this 172 area, maybe down to 71, 80s, that sort of area. If we get below there, then we're going to undo all the hard work that we've done in this bounce and potentially head back through 170 and lower. Again, Mavi, give me an idea what you want to talk about. It's okay throwing up a pair and saying, can I look at it? Yeah, I can give you my opinion, but I don't know what you want to do with it. You might be long, you might be short, you might be looking to buy, sell, whatever. So give me an idea what you want to do with that one. What's that going? Russia's Lavrov on possible peace talks. We are willing to listen to any suggestions, but we cannot say in advance what this or that process will lead to. Yeah, there was another comment I half picked up this morning, saying that they're willing to talk, but it was all a bit flaky. We've heard this before from Russia, saying, yeah, they're happy to talk, but certain conditions have to be met. The last couple of weeks, it seems that the Ukraine have totally walked away from any possible talks. So could be a bit of hot air from Lavrov there. We'll keep an eye on that one. Mike, you're looking to short cable around 115. Yeah, that's your level. So keep an eye on that one there. As we saw in the bounce, that's where it ran into trouble. Where was it? Mark wants to look at Aussie dollar. Yeah, this is another one I've started buying in. Not looking too hot at the moment. Started buying in the 64s, and we've had a real shove down on this one. I'm going to be looking at this 62 level. I'm going to look to potentially add to my position there. I'm in at 64, 63, 70, 64, 78, 63, 16, I think. So I'm going to look at 62s to add to the position. But if we break that 62, I'm not going to potentially add to that long till maybe the 60 area, if seen. Because this is looking really ugly. And just as I was talking about for the dollar yen trade, not risking a lot on this one, taking the volatility into account. If we break 62, I'm going to have a little bit of an assessment, see if I want to continue adding. And 60 is really my possible line in the sand. If we get down to there and break that, then I'll potentially look to fold it up. But yeah, the Aussie dollar is one. I think if we do get a snapback or the dollar going the other way, this will be quite a decent one to get in. It's pretty far from the conflict in the Ukraine, a bit like the US. Economy's not doing all that bad compared to others. So when we come to seeing who's got the dirtiest shirt, the Aussie dollar might be one of the cleaner ones if everyone else starts going into recession. So that's half the reason behind this trade. But as I say, I'm keeping a close eye on the volatility. Mark, as with the others, let me know what you're doing in it. I can't guess what you want to do in this one, but that's the levels I'm looking at. If we're going to turn this around, need to get back above that 64 at a minimum. For me, get above there, then find that we hold that as support, or it builds a support again, then we can start looking higher. But if we get up to 63, 70s, 80s, that line there, and find that it's becoming resistance, that's going to keep the bearish mood in play, and then potentially we're going to head much lower. Will it get to 57? Could do. Not ever going to rule it out. But again, what's it going to take to get to 57? Going to take a lot, but it's looking ugly at the moment. So I'm not going to rule anything out. If you're short, you know, where you short against, you know, you've got to find your levels where if we get there, you're going to take some profit off the table. If you're looking for longs at 57, oh, you might have a bit of a wait, but if that's your level, mate. And good luck if you get it. Khaled saying Kiwi is a better option to buy than Aussie dollar. Yeah, you might be right, because it has been taken down quite hard as well, nearer the COVID lows than the Aussie dollar is. But we also know that the RBNZ are potentially coming to the end of their hike situation. Again, the fundamentals not too bad over there, doing okay. So could see a quarter of bounce. Might be interesting to watch what happens at that COVID low if we get down there. We're not too far off, 54.69. You know, if we get down there, test it and hold it, could be a great trade. So one to keep an eye on. Oh, you have to excuse me.
Awesome.
I need a glug of water.
Excellent.
Right, Hugo, Euro, Aussie. I'll take a quick look at that one. Again, not one I'm trading an awful lot. Let me make sure I've got it in my chart. There we go. That'll be the last one for the day. because I want to let you boys and girls get back to your trading screen. As you can see, not one I trade an awful lot. Not got much tech on there. Again, Hugo, let me know what you're looking at in this one, and I'll get some coloured lines on my screen. From here, you're probably looking up at that 162s. You know, some of the easiest tech you want to do is just draw it off a former highs. So up at this 162s is an area you want to look if you get a bounce here. This break above this area here could be a little bit significant if we can hold it. Let me get a line in there just to clear that up. Zoom in. There we go. So just as a rough idea. So we're above this area here, former support resistance. If we start to build, if you get support coming into this, then you're potentially looking for a bit more upside. Get back below, find it's holding as resistance, then you're going to be heading lower. You know, I may not have a lot of tech on the charts, but you can always do the simple technicals. You only need, you know, one number to base your trades off of. Stay above here, you're going up. Go below here, it's going down. You know, keep the text simple. But let me know, Hugo. I know you're in our chat room as well, so if you want to let us know there, then we can delve into it a bit deeper. Whew, that was a long sesh. Okay, right. I'm going to let you boys and girls get back to your trading screens. Thank you very much for coming to the Flow Show. Still, thank you as always for your
Ryan.
input.
Thank you, everybody, for being here.
Yeah, and we'll see what today brings us. Have a great session, and we shall see you all tomorrow morning. Thank you very much.
Cheers.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.